Yep, we've been doing exactly the same thing for the last 8.5 years, and it really starts with trying to identify long-term trends that we think are going to grow in importance, broadly regardless of what's happening to GDP, broadly regardless of what governments and regulators are doing. We've been producing research on this for the last 8 years, and the fund is the culmination of this process. I think the key point we're always keen to stress is that our fund is about pan-thematic diversification. In other words, we invest in everything from cloud to wind and from fish to chips. In terms of what really sets our fund apart from the pan-thematic approach, is that we are very, very concentrated, 20 to 25 holdings. We have a proprietary process. We have a lot of emphasis on environmental, social and governance factors. I think in general terms, it's very easy to identify a theme. It's much harder to identify stocks that benefit from that, and that's why we have a very rigorous process. Cannabis is obviously a very hot topic, and we're seeing it sort of everywhere: food, beverages, even pet treats at the moment. And from our point of view, the crucial factor is really separating hype from reality. We understand that there's some very obvious drivers here. There is a shift towards decriminalization. There are perceived health benefits, certainly relative to alcohol or tobacco. And also it's a great way for governments to raise tax revenues. So lots of companies, unsurprisingly, are jumping on the bandwagon, and there is this huge substitution opportunity. If you look at the size of the addressable market for alcohol or for tobacco and imagine that some of that expenditure went into an area like cannabis, then the opportunity could be significant. Therefore, what you've seen are really two things happening. One, a lot of big FMCG companies jumping on the bandwagon, and two, a lot of small startup businesses emerging. Our concern really is that there are a lot of players in the sector. Consolidation almost certainly needs to happen. It's very hard today to identify the winners. And then at a very sort of pragmatic level, when you look at the valuations for these businesses, from our point of view, it's very difficult to justify an investment today with so much uncertainty out there. Yeah, Keysight was our most recent investment in the fund in April. We'd been looking for some time to find an intelligent way of getting exposure to the theme of 5G. For those listeners not aware, 5G is absolutely crucial. It's really the next stage in telephony and in data. And if you believe in autonomous vehicles, you believe in the Internet of Things, then you need 5G. And our investment case for Keysight is really premised on one simple observation: without Keysight, 5G can't happen. Keysight's effectively a network test and equipment business. It came out of HP Labs originally, was owned by Agilent for a short period of time, and then demerged and was listed of its own accord in 2014. 27% annualized return since that time. And the reason why this company has been so successful is they're absolutely unique in the field. What they do is they're essentially physicians by training. They test how photons and electrons move around mobile networks. And the great beauty of the story is that it really doesn't matter whether it's Ericsson or Huawei who's installing the kit. It doesn't matter whether it's BT or AT&T who's buying it. It still needs to be tested by Keysight. If you add into all of that the valuation for this company on consensus earnings expectations, this company is trading on 18 times earnings, 10% earnings growth, which to us is very justifiable given the prospects ahead. ESG undoubtedly is becoming much more important for all of our investors, and also as a discussion point, as you say, with the companies with which we engage. From a future trends point of view, we've really been thinking about ESG for a long time in terms of best practice of how companies are managed, in terms of sectors we clearly wouldn't invest in, such as firearms or alcohol, and also in terms of really what we want to ask when we meet management teams. And I would highlight three things in particular. Number one would be, where are the areas where you feel you can most improve, and how are you going to do it? Number two is, to what extent do you believe ESG targets should be linked with your own remuneration targets? And number three, to what extent, if any, do you believe reaching ESG goals conflicts with commercial objectives of your business? I think it's very difficult at the moment to resist the sort of positive narrative that's ongoing in the marketplace. In other words, central banks are continuing to underwrite the current economic expansion, and there is really a fear of missing out, which we think is driving equity markets higher. There are obviously concerns on the horizon. We could point to several factors, whether it's the growth in debt, particularly in the covenant light area, the rich valuations that some recent IPOs are also achieving. But I think our real sort of taking a step back perspective would be, H1 was great for equities, 18% return roughly for the MSCI World. Your starting point today and even given the strong returns from equities we've seen over the last decade, not just H1 this year, means that where you can get future returns going forward is going to be much more challenging. So our conclusion and how we position in this environment is really it's about finding the differentiated, so active over passive strategies and managers with very, very high conviction.